This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today. Kenny, welcome back to the show. Honored to catch up with you and have you on again. It's been a while. We were just looking it up, and it was you were on show 222 back in the beginning of 2019. So a lot's happened since then, no doubt about it. But you're one of those in the business that I respect in a big way, and you're out there making it happen. And so I love talking to guys and gals like yourself that are very experienced and are doing well, especially in times like this, right? When deal flow's almost non-existent on the multifamily side. I know we're going to jump into that. Why don't you give the listeners, though, a little bit more about your background? It's been a while since you've been on, and maybe you can highlight some of the things in your business, or maybe we'll talk about a few of them, because just so the listener knows, we're going to do a series. We'll do at least a couple shows with Kenny, and highlight some of those moments that have helped you to move forward, in this space and in your business as you go.
Sure. Yeah. So I'll kind of update everybody. We now are at 715 million assets under management today. So we're knocking on the door of the billion mark. It's pretty exciting. We think maybe next year we'll cross over that because a few of we have some development projects that should be delivering starting first quarter next year and kind of rolling off the assembly line. So we do existing multifamily, like you said. We've done that ever since 2010. So almost 14 years in the space in commercial real estate investing. And then, so 7 years ago, we still buy those today, but 7 years ago, we added two arms. So we have a triple net fund, a retail fund. We actually have five now. So this is on our fifth fund now. They're great for monthly cash flow, all high credit tenants. So think Dollar Generals, Walgreens, CVS, those kind of tenants in those funds. And then the opposite of monthly stable cash flow is development. So we do both ground up multifamily now in Texas and Ohio. And then we got into the office conversion to multifamily game about 3 years ago, right in 2020. What better time to buy a vacant office building? So now we have 12 of those office conversions going on right now, 2.2 million square feet across the country. 11 of those are for in downtown locations. One is in the suburbs. So we're excited about those projects. And like I said, those should start. Our first one should be delivered back to us in January, February of 2024.
Yeah, nice. Give us maybe some of the big moments in your career that were big leaps for you. All right, 2010, you got into multifamily. Was there something then that really set you on a path to success? And maybe a year or two later, or was there anything
Sure.
that stands out to you as like, man, these are the crucial moments that really push me forward?
Yeah, I mean, I think it's 2010 was a big move. I came from oil and gas accounting, so I had no background in commercial real estate. But I was, I think, fairly intelligent. Just surrounded myself with vendors and folks that would help me get to our end goal for our investors. So the management company, picking the right insurance team, all those kind of things, lining those up beforehand, figuring that team out. Definitely shortened the learning curve for us. And then really the other kind of key things were kind of leaning in. And so we branched out quickly. 3-4 years into it, out to Colorado. So we bought out of state pretty quickly as well to widen our deal flow. And then I'd say 2020 was a big deal for us because I just kept coming to the office. I deemed myself essential. And just kept coming to the office. I stayed home for like a day and couldn't do it with 2 dogs and 2 kids. So anyways, I love them, but it was too loud. I couldn't focus. So anyways, came back to the office and just really grounded out. So we ended up buying a very institutional deal, a deal that should have gone to an institution group buyer in downtown Dallas. And that kind of put us on the map. And then again, we bought our first vacant office building, the Rockefeller building in downtown Cleveland. That also was a splashy kind of headline. But those key deals, when you kind of can lean in at a time when maybe the institutional guys back out, is a way to really move your business in a big way. Because then after those 2 deals, we started seeing all these institutional style deals brought to us. We were kind of invited to the table, so to speak, once that happened. So that was a big deal for us as well.
Nice. No, that's awesome. Leaned in. I love how you express that. It's like institutional deals that maybe not too long before that you may have thought were too big for you, right?
Exactly. Yeah, absolutely. Yeah.
Yeah, yeah, good for you. That's awesome. I love hearing stories like that. Well, let's talk about multifamily a little bit. I know that was your bread and butter, right, for a long time.
Right.
And like most of us, what's your sentiment on multifamily right now? And I know I want to get into how you all pivoted and into some the triple net and the office conversions. We're going to talk about that just so the listeners know as well. But where are you at on multifamily right now? Maybe some expectations around multifamily. What are you seeing? And let's talk about it.
It's really strange right now for multifamily. It's a really weird time to be in it. It's been weird for a while, I guess, but this is really strange because what you have now is underlying metrics. So your rents are still going up, your occupancies are really high, but your debt's crazy, or it could be crazy, right? So that's the thing. If you have low interest fixed rate loans, then you have then the grass is very, very green and will be for the next 10, 15 years, whatever it is, foreseeable future. It's the folks that bought in the past, I'd say 20 and 21 and on. If they did a bridge loan, that's fine as long as you bought a rate cap. If you didn't buy a rate cap, then you're being hammered right now by capital costs. I mean, there's just no way to keep up with that quick of a spike in interest rates. And then even those of us that did buy rate caps, what we're watching is, in 2024, 2025, you're going to have these your loans are coming up on these bridge loans. So what are interest rates going to be? No one really knows, right? So everybody's kind of watching that very closely on the debt side. But again, your underlying metrics, your rents, your demand is outstripping the supply, and will for decades to come, just because we're so undersupplied as a nation. Some markets are better than others on that, but still, I mean, you got the wind at your back on that side. So as long as you can figure out the debt side, you're going to be just fine. But there's going to be some pain felt for sure by folks that either didn't get the rate cap or just have bad timing on resetting if they're not stable now, going to a Freddie Fannie loan.
Yeah. Yeah. Those that are, I guess I'm sure you've seen some already that are in trouble, right? I know I have had different people text me and say, "Hey, Whitney, have you know anybody that's done this yet or been through this or done a capital call yet?" Or, and are asking questions because there's definitely some distress, starting. What do you see as some options? I know that like every situation is so different, right? But at a high level, maybe from some that you've heard from already, what are some options for them that you know of, or from that they should be doing right now to maybe not lose a deal, right? Or have to do a capital call.
Right. I mean, so it's all about surviving to 2025 because everybody's basically agreed that interest rates will be lower in 2025. Maybe that starts in 2024. No one really knows. The Fed doesn't even seem to know. It seems like, but now with this war in Israel, it's going to be interesting to see how that affects the Fed as well. But anyway, so everybody's watching that. So for those that are in specific deals, I mean, it's really kind of going to your lenders now before you have trouble, and trying to work out kind of an early extension or something. Again, just your goal is to push that out till 2026, knowing that in 2025, it's all kind of, I guess, understood at the moment that it's going to be back to a big seller's market in 2025, as long as you can survive 2024. So that's really kind of what everybody's trying to solve for now. So you're digging in and like looking at each deal. When's your loan deal due? Hopefully it says 2025 or beyond. If it doesn't, then those are the ones you got to focus on now, and maybe go to your lender, try to get an early extension, try to work with them already before you're in trouble. And like you may have to do capital calls. I mean, no one likes to do that, but right now as a syndicator, I mean, your number one job is to save the deal, is to save your investors money. And sometimes that means saying that ugly word, the ugly phrase, capital call, and no one likes it. The investors won't like it. You won't like it. But again, you're trying to save the asset. That's number one. And then again, if you can make it through 2025 and beyond, then, again, interest rates should be down lower. And then you're going to be just crushing it on the returns since then. So that's really kind of, I don't know, that was a lot to unpack maybe, but that was a long answer. But that's really kind of what we're doing up here now too, is weeding through all that. And then I know other syndicators are as well.
Yeah. Yeah. No, I loved how you said that. And even placing the first priority on, hey, we're not losing the deal, right? Not losing investor capital, even if it means having to do a capital call, if it gets you through till 25, right? Then,
Right.
hopefully you can still save the deal and save your investors money, right? Even if it means everybody having to put a little more in at the moment. But are you still looking for multifamily deals at the moment? Are you still expecting to be able to close any multifamily deals right now? Is that a focus at all for you all?
So we did close one this year, or in the it was in April. It was a rollover for 2022 though. There just wasn't been a lot of deal flow. I mean, I think I heard a quote that the sales volume is down 75% from last year for multifamily. So you're just not seeing a lot of deal flow on that side. So we really haven't even, we've seen some, but nothing that is super exciting at the moment. Everybody's kind of sticking to their pricing at the moment. So we actually tested the market on 3 of our assets that are stable, just to see, well, what's the value, what's the market paying these days. And so one of those deals we already went to best and final. It's a deal here in Dallas, Fort Worth, but it's actually our first syndication deal. So we've owned that thing for a very, very long time. We just wanted to test it out because we didn't have to sell it, but we're selling it at about a 5.5 cap. I mean, it's a B class deal. It's nice, it's fixed up, it's stable. So they're able to go to Fannie and Freddie, get fixed interest rate loans, avoid the rate cap. And the other 2 are in Cleveland, Ohio. And again, those are probably maybe only a 5% discount from last year, from 2022. So you're still seeing it. Folks are very, very hungry to do multifamily deals this year. And if you do put one on, like we did, those 3, you're kind of the belle of the ball because there's nobody else out there selling anything. So it was interesting to see that too. And we're going to hit some awesome returns for our investors on all 3 of those deals.
Love that. It's incredible. It's nice you don't have to sell them, right? But you can
Right.
go out and test the market like that and see what happens. And it's interesting to hear the turnout, though, of buyers, right, for those deals. And so, congratulations to you. You all making that happen and having some deal flow there. Speak to the when you determine to say pivot into some other asset classes. I know you're doing a few other things now, as well outside of multifamily, like the triple net or the office conversions, and we'll dive into a couple of those. But when were you comfortable to say, hey, let's go tackle this other asset class as well? Outside of, say, your maybe multifamily was your main focus, but you did decide at some point to branch out.
Yeah, so 7 years ago, around 2017 for both, actually, for the retail fund. We did our first retail fund, bought $7 stores in Texas and Oklahoma. All my investors thought I was crazy. Kenny's lost his mind. He's the multifamily guy buying dollar stores. What's going on? So it took a lot of education. So if you are a syndicator and you're known as a multifamily person, and you jump into any other type of offerings, it's going to be like pulling teeth. And so I think on that first fund in 2017, we only raised like $1.7 million, which at that time we were easily raising $4 or $5 million, maybe more a pop on a multifamily deal within like a couple of days. Right. So it was like pulling teeth. But then it really caught on. So now we've got 61 of those stores. So the 2022 fund, we raised $20 million. In that single fund, bought 24 stores in that fund. And those are great. Like I said, they're all high credit. So you're buying those for your monthly cash flow. And so really we had a request from an investor who wanted more, multifamily is great, but it's operational heavy, right? So you have to chase rents and you have to fix toilets, right? And so it's going to be up and down every month. But they wanted something more stable because they just wanted to roll around their RV, collect ACHs, every month from us. That's just very stable. They could rely on it. So basically that was the idea, was to strip out the operational risk as much as we could. So I actually talked to a guy that was a mortgage broker in the business, Paul Peoples. You guys probably know him with capital. But talked to him, asked him, what do people do after multifamily? Thinking that maybe there's some progression there. And he said, they either do medical office or they do triple net, not because you make more money, but because they're a lot less headache. So anyway, so we jumped into the retail side. We love those. Again, all high credit there. And then the development side, That one's a lot more moving parts. And so that one, I just went out myself, bought some townhome lots across the street from our first syndication deal. And then knew I wanted to do a deal that was already zoned. So I didn't have to mess with zoning. I talked to a developer about that. He says, never fight City Hall, just, buy stuff already zoned. And then also too, I wanted a deal where I did have to work with the city a little bit. So so it was 4 townhome lots and I could turn them into 6. And so by the Texas code. So anyways, went there, did that, worked with them, had to present in front of the city hall and the city meeting and everything like that. So it was good practice. Basically built the team, the GC team, and then my team that could manage that process as well. And then, we did that deal, made some good money, and then ended up buying 6 acres and doing an 88 unit ground up multifamily deal. So we could prove it up to our investors that we knew what we were doing. And because it's a 160 step process is what we have it down to. So it's a lot more than your existing multifamily, and definitely way more than like the retail fund. So it's really building your team around you and making sure you have that before you go out and syndicate your first ground up multifamily deal.
Yeah. So you found some development experience to either partner with or bring on the team, I guess, before doing that, or how did you do that?
That was the whole idea behind those townhomes. Build those first and get a feel for that, and get comfortable with that process. Because if you can build 6 townhomes, you can do 80, 100, whatever it is. I mean, it's about the same steps. It's just you make more money on the bigger one. So you might as well go bigger.
Yeah, might as well. So how did you narrow down, Paul Peebles said triple net or medical office. What were your thoughts about, those, like medical office or, but you all went into, the triple net, Walgreens, Dollar Generals, those, what were some of the deciding factors and what asset class you were going to move into?
Yeah, I mean, so I like the high credit. I like the guarantee of those Walgreens and Dollar Generals because the parent company guarantees the rent. So since 2017, we've never missed a rent payment at all from any of our tenants. And then even through COVID, we didn't have any kind of rent relief or even a rent reduction request at all on all of our portfolio, because we focused on these high credit tenants, and they were open all through the pandemic, all of our folks. So we really didn't have an issue with that, and I'm glad we did, because there's other folks that I knew in the business that they went into like strip malls, strip centers, and they had a lot of mom and pop owners, and they definitely had rent relief requests and things like that. So they were really kind of nervous throughout COVID, but ours, again, because who we picked on the guarantors and they stayed open, we didn't have any kind of request at all. So I think that was good to stay with those high credit tenants like that on the retail front.
Yeah. No, that's incredible. Great to know that as well. Speak to maybe a couple of things that maybe the passive investor would need to know when they're investing with an operator in a triple net fund or something like that. What are some questions, if they've always done multifamily, what are some things they need to know about that type of fund?
Sure. Yeah. I mean, I think it's definitely, what's the track record? And also, you need to ask, what's the biggest risk? So the biggest risk to those is buying one store. And that's why we do a fund setup structure. That's the only fund structure we do is because if you buy one store, it could be risky, right? Because it's like buying a single family home. If you're vacant, you're 100% vacant. So it's more risky to buy one house than 3. So anyways, that's the thinking, is that we put it into a fund structure. So that was a big deal. The other thing too is, do they have experience repurposing buildings? So we haven't had any go dark since we started. We've done a lot of renewals already, but what we have made a point to do is acquire former Walgreens that now have tenants like Family Dollar, Dollar General. So we have that experience and know kind of what they're looking for, because what we're seeing now is, even if a Walgreens or CVS goes dark, you're seeing these dollar stores want to move up in square footage to those. And then the same thing if you see some Family Dollars or Dollar Tree, and they almost never go dark, but if they do, you're seeing auto parts companies trade up to the space. So what's interesting is no one really reports on it. All these retailers want more square footage. So we all hear this, like Amazon is going to take all the business. Well, Amazon has retail locations now that you can walk into, and then also all these retailers that we've seen, they're trading up when they can. for bigger square footage. So it's interesting to see that actually in the side on that. And then how high credit are your tenants? So we are 100% high credit. So all of our tenants, except for one at one location, they're all publicly traded. The one that's not publicly traded, they are still high credit. The parent company, it's an LA Fitness outside of Orlando, but they still guarantee the rent. So we are 100% high credit. A lot of folks are maybe 60, 70% that are in the business as well. So
okay, so that passive investor, man, they need to know obviously the operational experience of the operator, right? Or have they done this before? No doubt. But I liked what you said. The biggest risk is buying one store.
right.
Sometimes I think you would maybe even an investor, of a group that they trust. They might want them to the thinking might be, well, I only want them to start with one first, right?
Right.
But man, that could be the opposite of what really needs to happen, right? But I like that how you said that. But and then that's why you did a fund structure, no doubt about it. What about I was thinking about that type of project, that type of building. Are you all managing those as well? Probably a lot less management, less hassle, I'm sure, right?
Yeah, it's a lot less management, but you do have to do some. So we did have to create a new management company actually in-house once they hit about, I think, store for 30. Just because you do, so we get reimbursed for property taxes and insurance. But you still have to pay it and submit it and get reimbursed and so track that. And then some of these are double net assets. So kind of a worst case scenario is our typically Family Dollars. Those we're responsible for the roof, the structure, the parking lot, and part of the HVAC. And so we have to manage that as well on the CapEx side as well. So it was enough that we around, like I said, I think it was around 30 that we created that new management company. And like you said, it's a lot less, but there's still enough to be where you need some hands-on experience about getting reimbursed and all that.
Yeah. Wow. Okay. And then, I want to dive in more in a moment to the office conversion. I know we've received a lot of questions about that, or people wondering, hey, is that even possible? And they've heard a lot of the issues, that you run into. Sounds like you're tackling that head on. And all these office spaces that are vacant, what do we do with them? There's got to be a way we can use those, right? Or use that space or convert them to something. And we're going to dive into that today. Kenny, welcome back to the show.
Thanks, Whitney. Appreciate it. Yeah. Thanks,
yeah, let's do that. Let's just hop right back in. And Kenny, I know I think you mentioned in yesterday's segment that you're doing 12 of these right now, which kind of blows my mind a little bit. It's awesome. I love that. But office conversions, let's talk through that process a little bit. I've heard different people say, oh, it's so difficult because the windows aren't in the right spot, or the electrical's not in the right place, or like we can't use these buildings for multifamily or whatever. But talk through the process a little bit of what that looks like to take an office building to multifamily and why you would even consider it.
Sure. I mean, like you said, there's a whole bunch of vacant space in the B and C class office spaces, especially in downtown locations, really everywhere, but downtown is kind of where we're focused on. The A class is actually interesting. The A class office is actually increasing rents and occupancy right now. So it's really kind of a tale of two cities. But in B class and below, if you're not highly amenitized, if you're not the newest thing on the block, you're really struggling right now. And so that's what kind of we're focused on. We're buying these for pennies on the dollar right now. There's a lot of distress in the office space right now. And you're seeing it now. I mean, we're buying our first foreclosure right now directly from a bank that took back an office building. So we're starting to see those kind of start coming to fruition. I think it's going to be picked up the next 12 months or so. But it's a commercial, this is a commercial real estate issue, and so it's going to be pretty clean and quick. So you got to be ready to capitalize on those. And so we're buying these, everywhere between $40 and $90 a square foot. In downtown locations, irreplaceable locations, walk scores of 95 plus typically before we even get there. And so awesome locations. So we're buying them again on the cheap. These guys probably paid $200 to $400 a foot for what we paid for what we're paying compared to that. So, but it is a big construction site. We consider it development. You have to wear a hard hat on site. So we got the entire floor. You get down to the cement deck pretty much all the way. You're having to redo electric, AC, plumbing. I mean, you get all brand new systems, which I like. It's like it's an A class. It's almost like a ground up. I mean, you're getting brand new systems throughout the building, and then our finish out, we're going for A plus. So quartz countertops, granite countertops, Bosch appliances, those kind of things, those high level finish outs that we're going for. And then we're commanding almost $3 a foot rents. And so those are really interesting deals. You have to know what you're doing, or like we did, hire somebody for our first one that did. So we teamed up with some amazing architects that knew exactly what they're doing, and they've done this many, many times before. Then also teamed up with some national general contractors as well that have done these adaptive reuse projects before as well. So those first couple, we were learning a lot. Now we know what we're doing after 12, in the process. So it's really about plumbing. That's the biggest deal. I mean, everything else is pretty easy to run because you've got, that middle, usually it's a middle core of elevator shafts and all that kind of in the middle of the building. You've got a hallway around, and then you got windows, right? So, but really plumbing is the biggest deal. And it's a lot of core drilling. I mean, you're just coring down all the way. These buildings that we're doing are 17-story buildings, some are 12. Some are 24. So it's a lot of core drilling to get new plumbing in the system. And then we usually have way too many elevators. And so we can use one or two of those as to run our utilities, do a trash chute, those kind of things. So you have to be a little creative because you have to live inside this box. You got a floor plate that you have to live within. And how do you maximize how many units you can put on there and still make it feel roomy and open? And you've got some amazing views. It's just we love these projects. They're downtown, and we're probably all in at the end of the day, maybe $200 to $250 a square foot net. And I say net because they're 8 of our 12 are historic buildings. And so we get a lot of grant money from the federal government, most of the time the state as well, depending on the state. So we get a lot of grant money on that. And so the federal government is, guaranteed you're going to get 20% of your hard construction cost as a grant in year 5, which is amazing. And then the states all vary as well. So like in Texas, they just do an additional 25% from the state of Texas. So 45% of your construction cost, your hard construction costs, are a grant on these historic office buildings in Texas. In Ohio, it's a competition. We won it 2 years ago for a property. We just submitted now to be on the competition now. But if you win, you get an extra $5 million of equity from the state of Ohio to your project, which again is a big deal. And then we're also seeing seller carries too. So there's a lot of there's enough distress where we've had sellers actually 4 times now leave money in the deal, so they don't lose their shirt. They make some money, and then we come in and do with our investor group, come in at a higher ownership percentage, usually about the similar equity amount, but a higher ownership percentage. So we're getting some extra juice for our investors as well.
Incredible, man! Many great items there. I was just taking a bunch of notes. Love that. Yeah, that was great. It sounds like plumbing is the biggest issue, drilling through the concrete and all that, but it can be done, right? I love that we didn't just say, hey, it can't be done. No, we went out and we found architects who know what they're doing and said, hey, how can we make this happen? Even figuring out the grant, man, that's incredible. 45% of the construction costs back.
Oh, it's a huge deal. So we bought this. Yeah. So I'll give you a live deal. So we bought a deal in Dallas in April. We raised $9 million of equity. We're going to get $16 million of grant money guaranteed. So it's fantastic. Yeah. It's just unreal. So our investors are loving these historic office conversions, and we've got more teed up. So we like them too. It's a little bit more work because you have to keep it historical, right? But it's definitely, well worth it for the returns for the investors. It doesn't add that much more per foot.
Yeah. Wow. Well, I'd love to dive in even more. Unfortunately, we gotta move to a few final questions. Or maybe tell me this, about this office conversion. When you are when you're looking for these specific spaces, what are some deal breakers that or there's no way we can do this one, or versus the ones you all have selected?
Sure. So far, the biggest floor plate, so one floor that we're doing right now is 32,000 square feet. So which is a pretty big floor plate. There's 17 stories of that, but 32 square feet on one floor. That one we had to be a little creative on some dead space. So when there's lack of windows in one section or whatever, you got to figure it out. And then you also have to keep in mind fire code as well. So how quickly can folks get to the stairwell And then also making sure there's a firewall in between. So what we did on that one, we actually created some very nice storage lockers all the way down that hallway. So it broke up that hallway somewhat. So again, for fireproofing, and then solved our problem for the stairwell, and at the same time fixed this dead space. So it's kind of, you have to be that kind of creative throughout the space. I mean, some of our other ones we're doing, if they're bigger floor plates like that, you're having to get creative with the dead space. So some of them are doing like alternating kind of like business kind of lounges on every floor. To a video game room, a movie theater, like that, kind of break it up on those floors like that as well. And then you can have a lot of fun in the basement. So there's these usually have basements, and so you try to put all your utilities down there if you can, your boilers, your whatever you have down there, all that right there. And so that definitely helps with space. But again, it just comes back to, make sure you have got the knowledge from those architects that have done this, especially on the historical stuff, because you got to preserve certain walls, certain finishings to qualify.
Yeah. Or do you see this continuing, this opportunity to convert office to multifamily, or you see maybe it drying up, or more people doing it, or maybe people coming back to the office? What are your thoughts?
I think if you're not at the office now, you're not going to come back. So I feel like everybody knows kind of where they're at now on their physical occupancy. And that's a big thing to talk about too, is office buildings occupancy. Make sure you ask the broker if they're leased, or is it physical occupancy? That's what we want to know, physical occupancy, because those leases are going to eventually burn off, and those are going to be trouble, right? So you want to know that going in. But if you're not back to the office, you're probably not back now. So I feel like everybody knows kind of where the occupancy is. And each city is a little bit different on that as well, and what industry that you're in on the occupancy. But then, so now the owners know, okay, I know my occupancy, I've got debt issues. If I do have them, they're really big right now. And then how do we get out of it?
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.